Day Trading Radio presents a Briguy trading production.
Good evening, boys and girls and fellow traders. Good to have you here with us for Briguy's Tools of the Trade. Interestingly enough, we have with us today a fellow trader, Pop29. You might know him in the futures room. And coincidentally, this happens to be episode number 29. No, it's not. It's 28. Why did I even say that? I take it back. We'll have to have you on again. But anyway, as George Burns said, look to the future, because that is where you'll spend the rest of your life. And we will be talking about futures here on the show, and I hope you guys will enjoy that. Now, if I just get myself a little organized here, I do have our friend with his screen all set up. The next thing will be to get the audio set up. So, Pop29, I don't know if you have Skype open, but need to have you call in on Skype. And while we're doing that, let's move his screen up on the screen. Oh, there he is. I know he's looking for me. He's about to hit the call button. It's about to ring. I'm about to hear it ring. Pretty sure I'm connected to Skype. It says Skype. It says connect. I don't hear it ringing. I know he's on the other side of the country, so maybe this is a test of the quality of Skype phone calls. Traveling all the way across the country, and he's hearing my voice over the broadcast for whatever reason. I'm not getting it shown up on my screen, so just be in anticipation. I know it says no answer. Why does it say no answer? Let's see. It says I'm connected. It says Skype. Set status. It says online. Let me look him up. Pop29 is Q something. Let's try to figure out where you are, my friend. Maybe I can call you. Alright, this is wonderful radio. Don't worry, I will edit this out and you will never know the difference. Let's see, there's Kenny. I don't want Kenny. Here's Vester. Oh, here he is. Here he is. Found him here. Alright, I'm going to call you. See if we get a different reaction here. This is love, this is love, this is love. Hello. Hey, how you doing there, Pop29?
I'm doing good. How are you?
Oh, excellent, excellent. Now, let me check the settings. I have you on headphone. Let's unpause the video for a second here, or unmute it anyway. See if I hear you. I hear myself. It's still on delay. Maybe you guys out there can just confirm that you can hear Sean's voice, because otherwise...
Hello, everyone.
I'm still waiting for my video to catch up. Got a long buffer going on here. But maybe the folks out there can confirm.
Hello, everyone. How are we doing tonight?
Okay. I think it's working.
Hey!
Yikes. That is loud. Am I talking that loud?
Oh, well. Hope it's not me.
Yep. So, it looks like I got the video working okay.
Unpause the video for a second here.
And, I'm still not hearing your voice come over the broadcast, so I do see Trade for One putting a 1 in the room, I'm putting a yes in the room, and I'm kind of at a bit of a disadvantage because my laptop is not cooperating right now. So if somebody can confirm that they can hear Pop 29, okay. That would be helpful.
Confirm that they can hear.
I can hear myself.
Yep.
Still.
That would be helpful.
There's no one here.
Okay. It looks like they can hear you. All right, we're gonna run with it then.
Oh,
Otherwise, it'll just be me and you talking.
I can handle that. How are you?
I'm doing okay. You know, I've been taking small trades and not going too crazy. I've been breaking my rules as I have been wont to do. This one rule that I'm working on this year is about cutting my losses. And for whatever reason, I just keep talking myself into staying in a trade that I said the day before, if it did this, I'm going to cut it and move on. And the next day comes, it does this, and I go, well, maybe it just won't keep doing that, and maybe I can hold on a little longer. They are June options anyway. I have a whole month to go. And so I'm in a couple trades now that I've foolishly should have taken a $30 loss when they were $30 an option loss, instead of now they're $50 an option loss. And anyway, that's probably nothing compared to, you know, you being down $1,200 I heard the other day with RPM. So, you know, in comparison. Now, that being said, I really enjoyed having you on last time, and I started to apply some of the things I learned in talking with you, including the different indicators, but not just the indicators, also just the methodology as well, which we'll get into in a little bit. If you guys haven't seen the other show with Pop 29, please look it up. I did post it in the announcement, and I started trading. Even though oil is out there for me to do, I've been trading gold for whatever reason. I don't know why I went in that direction, but I took some gold trades. Some of the traders out there will know because I talked about it overnight when I was taking those trades. And yeah, the son of a gun will rip against you like a road rash and attempt to tear your heart out. And then whipsaw the other direction. So
sounds like oil.
Well, that's the thing, and I don't think it always is like that. I think it is in recent months behaving that way. But that's what you described oil is doing. So that's kind of why I thought maybe some of the methodologies will keep working. And anyway, I'm hitting singles. I haven't hit any home runs yet. I'm hitting singles, and I'm also taking the position of putting more than one contract on so that I could peel one off when I'm up and have a runner. And that also is helping to maybe get some doubles. I don't know what you consider a single or a double. I guess if you get 1 or 2 points in gold or oil, that's not too shabby.
No, that's not bad at all. Any day you walk away alive and green and money in your account is good.
Yeah, that's right. They haven't come and taken it away on you.
Yeah, exactly.
So I'm thank you for coming on. Let's give a little introduction for those of you who were not able to be here for the first show. This is Pop 29, aka Mullet Head, and if only for the fact that I have that picture on a different computer right now, I would definitely show it. But
it's in my library.
Oh, that's right. Well, you're welcome to show it yourself. It is your machine. But we had a nice time talking. And also, I know since then you've been on air with RPM. You've been on with FT71. And what I find intriguing about your trading is specifically your use of the audio diary, aka Dragon Speaking. Now, I don't know how much feedback you got on that from other traders, but it sounded to me from what I heard is that you find found it valuable not only using the diary but even watching the previous shows and kind of hearing yourself talk about some of the trades even more visually than I guess audibly.
Yeah, it's helped out a lot to listen to myself and actually listen to the shows. It's highlighted key points in the way I trade or the way I haven't been trading, so I can focus more on them. Like that, just when we started the show, you were talking about adding contracts. That's one thing that stuck out in my head when me and you did our show. Is the multiple contracts is has made everything that much. I won't say easier, but it's made it that much profitable to actually trade those contracts, take what you're looking for, but then let the runners run. And when they do run, let them keep running, because that one day can make your whole week, and then you don't have to fight so hard, and you can actually just have more patience and wait for the setup.
Right.
But from the first show, that's one thing I've taken away is I'm still only trading 2 or 3 times a day, and I'm done. So, and having the multiple contracts is helping out a lot.
Okay. So where do you want to start? Do you want to talk about your layout? Do you want to talk about a particular trade? And you have 6 minutes before the market opens. No pressure.
Oh, I'm not too worried about the market opening. But it's the same old analogy. The way I've been trading, the biggest thing I've been doing on lately is just concentrating on my feeling. When I did the little show with RPM and FT71, there's a couple points in there where I could actually hear my voice get elevated, and I wasn't really concentrating on the trade, and we kind of talked through it. So I've really been focusing on my emotions and letting the trade work to certain levels. And like right here, I noticed this is what I took yesterday. I took this trade right here off this PPS flash. So what happened was I just waited for it to play out, and it came up to our 50. I drew this. Well, I was short way up here. I got out down here on my first trade, but I took this second trade on long. But the only reason I took it is because I've been talking about this PPS flash, because I usually don't take the long trades. But we're right there on the 50% line of the downward channel, and this PPS just flashed. And when it flashed, it gave us this long wick. I've really been focusing on candlesticks lately. And once it gave us that wick, I actually took that trade right there. I didn't take it for a lot. I took it more for the confidence level, and this whole trade, PPS was flashing. I really concentrated on my feelings and my emotions about I had to force myself to trade that, which is, I don't know how to, I was hesitating, the PPS was flashing, it's on the channel line, and I can't, my emotions and my feelings, it's like you were talking earlier, holding on to your trades when you know you shouldn't. I had to force myself to take this trade to the long side, and it worked out, but more importantly, it was the time and effort it went into the actual emotional of flipping the switch and taking a long position, because I'm usually short, and then not only that, but taking after the PPS flash and actually having enough conviction and wherewithal to actually take this trade. Anyway, it worked out, but that's really what I've been focusing on lately is my emotions, my feelings, and really letting them play out. Because the indicators are all the same. I'm still trading the same way. I still have my simple 26 moving average, the PPSs, and then, this downward channel. This was Monday's trade from Sunday night when it popped up to that 97.17, which was this is a huge header on oil right now, this 97.17. I didn't take that short because I took it long here. I usually don't trade overnight anyway. But this header, I really went clear back to January on oil, and I don't know if you want to talk about it now, but taking swing trades and actually establishing when is a good entry and when isn't a good entry. And I'm really starting to figure out with oil, the highs and the resistant levels are, they're just there. I really thought this 97 would come up in Monday's hours and I could short that and try to do a swing trade, but it only tapped it. But when we go up I'll take you up to my 60-minute chart and clear back to January. It just, all the volume pushed it up. It pushed it up a couple of days before that, and I really wish I would have taken that for a swing trade and tried to hold it for a couple of days. But it was after hours Sunday night, and I chickened out. But when we get into the 60-minute chart, I'm really starting to focus on more trying to have more patience with it and and try to just swing trade it and hold it for more time periods. So that's kind of what I'm working on right now, I guess.
Mm-hmm.
So,
well, let's take a moment to, we don't want to just repeat everything from the prior show. We hope you guys go back and watch that. But for those of you with us tonight, just to kind of explain some of the terminology that Pop29 is using. So he uses an indicator on the screen called the PPS, which is in Thinkorswim. It's just PPS, Papa Sierra. And if you notice all these purple and pink arrows he has on the screen, those I believe he's changed the defaults because I think they're green and yellow.
No, they're actually the blue. Sorry, they're the blue and the yellow. These other pink arrows are more. It's a different indicator that I've added in the last 3 or 4 days. I'm just playing with.
Okay, I thought they would look a little different.
Sorry
all right,
that.
So it's the pink. The blue and the yellow. Okay, that's the smaller arrows there, the blue and the yellow. And when he talks about, all right, so now I understand the PPS flash because I saw the purple arrow there and I didn't understand why you were calling it a flash. But when the PPS indicator is working, it will flash an arrow as it's setting up for a pivot area, and based upon the order flow, sometimes the arrow will disappear. So you need to kind of wait for that arrow to stay solid and it moves on to the next candle before you can commit to it as being a true signal. And what Pop29 has been doing is highlighting those flashes and making notes on his charts as to when they flash but maybe don't stay solid. So you're saying in this case on the 5 minute it flashed but didn't stay solid?
Yeah, it flashed right there.
So now it looks like based on that blue arrow that it was set up for long. Are you saying it was flashing a short signal?
Well, that blue arrow didn't come on until it committed past probably this new indicator doesn't come on for another 5 or 10 minutes after it commits to a different direction, to the long or the short side. So that really, I'm still playing with that.
But I'm talking about the blue arrow. I'm sorry, I'm talking about the blue arrow that's back on the dotted line.
Yeah, it came on here, but it flashed way up here and was flashing yellow to the downside.
To the downside, that's what I thought. Okay.
Yeah. And the way that usually works is it'll fill 3/4 of the candle, the next, like right here. Well, I don't want to do that. Right here where it popped up on the blue, I don't know if they can see that very good, but it kind of came down and filled halfway to 3/4, and that's usually when I take a trade off a PPS indicator, is when it fills or comes halfway into the previous candle where the PPS actually stayed on. That's usually how I try to get my fills, unless I just feel really good about it, and then I just use it as a overall indicator to the downside or the upside to help me stay in the trade longer.
Mm-hmm. Okay. So in this case, you were talking about forcing yourself to take the trade or stay in the trade?
No, I was forcing myself to take this long right here because this was flashing a PPS to the downside.
Yeah.
So it was trying to, we had the PPS down here, it went up to the midline, and this, kind of played out the same as it was up here, and then it broke down. So it started flashing right there, and I had to force myself to watch the trade, watch the PPS flash, and then finally, the PPS gave itself up, didn't hold. We still had one down here to the long side. We came a little sideways or flag, and then it came up through here. I didn't get in long here till almost like right here at the 95, 69, 65 area, if I remember right. But I had to force myself to take that trade. The emotions were so against me trading this. It was just crazy. I can't believe how much emotions play into it when you just don't trade that way, when it's something different or you think you might be wrong. Mm-hmm. And I really focused on this specific point in this trade, which was just Monday, and that's why it's still stuck in my head. And anyway, I think the emotion thing, I can't emphasize enough how important that is to trading, and not to hesitate when you're ready to trade. So that's really what the PPS was doing there, and that's the only reason I'm really talking about it, is because of how much I had to force myself to take this trade and play it out to the long side, and then talk myself through it. And after talking to you and listening to the show, but especially with RPM and FT71, And there's a couple places in that video where my voice just, you can hear it elevate, and I'm getting emotional, and I'm not, I bring myself back to even, I guess, but there's a couple times where I just like, really, really, I sounded like a little girl. So that's what's helped out a lot, is listening to the videos and then actually really, really staying focused on my emotions and letting myself trade what I see and not what I feel. And oil, it's just crazy. I mean, right now we're kind of just sideways between the 96.27 and the 94.82. And it's been sideways since it came off Sunday night. Everyone thought it would push back up to 97, but it doesn't want to do it. It's just, and my line's in the sand, which we all know, we're riding it right here on Monday, and then we're riding it today. This is my midway point. The line in the sand's actually here, but it's just riding this midway point. If it really, to go higher, we got to get through the 96.27. To go a little lower, I really think we got to get below these lows of the 94.87. But once we do that, I really think we're going to lose this line. And every time we cross that, and if we hold conviction through the 15, I mean, it's been a $2 to $3 move. I mean, I can take you up to the 15 and show you when it crosses there, and it just, this is really what I'm waiting for. I'm trying to right now get a short position to the downside, because I just don't have any faith above the 97 to 98. So I'm trying to get in a short position right now to the downside, lose these lines, be in the trade before I get here, hold conviction through the 15, and then I'm going to try to hold that trade for 2 or 3 days if the contract doesn't run up. I'm kind of running out of time, so I'm hoping it does something before the contract rolls over. So that's kind of where I'm headed right now, is trying to short. Right now I'm specifically looking for a swing trade to take for 2 or 3 days and lose this line to the short side.
Okay.
After coming off the 89.90 low, it's just and then pushed up to the 97.17. Crossed our lines. I just don't. That's what I'm headed right now, trying to do.
Now that 97.17, that was from Sunday, you said?
Yeah, that was Sunday night. It opened up and it blew up. It didn't stop till it got there, and I mean, it blew up 100 ticks almost off the opening on a Sunday evening.
Now, how much of that was the geopolitical situation?
Who knows how much it was. I mean, there was some there, but once it got to that header though of 97, that's all I cared about. Why it gets there, or how it gets there. I should have shorted it, but I didn't.
Was that a prior? Was that a prior high?
No, the prior. Well, yeah. I mean, if I bring up the 60-minute chart. The 97's just been huge resistance since January. We've only popped through it a couple times. So this is my 60-minute, 1 hour chart. Can you see that?
Yep, just takes a moment to show in, but it's there.
So right now that red line is from the high way back here, the 98.24, which was basically the 30th of this year. And ever since then, right here, we touched it at the 98.04. We touched it 1, 2, 3 times, and the thing just fell off. And then we go clear over here back to this is March 3rd, the 27th. We tried to push through the 97 level right here at 97.44, 97.60. It still wouldn't do it. And then that line's been drawn there since we hit right here. I just ran it long. And then we came up and just touched it right there again. And I'm really getting to the point where, if it trades what you see, you really just need to trade it. I mean, it does not want to get, it does not want, the market, I mean, the market's pushing all-time highs, but, oil's oil. It's only going to go, people are only going to pay so much for it, and right now it's just not going to push these highs. So I'm really I wish I would have been short up there, but anyway, I'm looking for a short to the downside. Get out of this channel. This channel I drew clear back in January. This 97 to 94.14. That channel's been drawn since January. Then I got another channel down here at the 87 to 85 level, and basically those are the lows and the highs for the last 6 months almost, from basically mid-December to now. And that's the range it's trading in. If you're in or out of it, or long or short of it, I'm really looking to start swing trading this off these these parameters or whatever you want to call them. So that's kind of what I've been focusing on lately, is the overall environment of how it's been trading for the last 6 months, not just the day-to-day tick by tick, which is doable, but I'm really trying to just swing trade it and not have to fight it so much, I guess.
Mm.
I mean, the way it played out at this 89, what date was this? This was the day after. This is my 15-minute chart. This was the day after. So right here is my great interview with RPM, and FT71 was down. I was short, and I took it, and numbers even came out right here. And I still, everyone says I traded through it. If I would have actually stayed in that trade, we lost that back down to this level of the 86.12 level. But what I caught as interest was the Sunday before when it opened up, or the Monday before, it was another low. It made it down to 86.03 or 06, something that night. It came down and touched it Wednesday when I was trading at RPM and FT71. And not only that, but then in the after hours, to push another low. But this low and this volume amount was almost the exact same as this prior Monday after hours. So even though that day I still lost and got out, what happened is I recognized this trade going 1, 2, 3, and then I took this long right here, and I actually held this overnight into the next day. And what I'm starting to notice is once it makes a higher low, I did trade this long. I took it at 86, I think 12 or something. But the point is, I should have stayed in the trade and added to it the next day, because it didn't come down to the new low. It made the new low in the afternoon hours, and then just pushed back up higher. And the next day, we did the same thing. It just pushed up overnight, came down midday, and then it made its lows for the day, but that's as low as it would go. It still didn't go below Tuesday's lows, and then it just pushed up again. And I know that kind of sounds like common sense, but if you don't start to really look at it in the big picture and try to get out of the day-to-day mindset that I've been focused on that for 3 months, you'll never catch these points. And this is something I realized because of FP71 and RPM, and I was kind of annoyed that I was down for the day.
Yeah, I heard him kind of repeat that a few times.
Well, that's why I took this trade. I was like, screw this. This is the third time. It won't break any lower than this. They haven't even come close to it for the last month. So I took it long, and then I started to recognize, look, if I would have I got it out somewhere up here that day, took my profit for the day. But what I should have been doing is recognize, look, we just made a low, 1, 2, 3. I should have kept my position instead of getting out of the trade, just hold my position, and then I should have actually added to it right here, and then let it go up the next day, and the next day until the point. I mean, even next the following month. Well, this is a Friday, so that Monday we really pushed down to, just barely pushed down to Friday's lows. So if you would have had enough conviction, if you would have been back here at the original trade, which was that Wednesday overnight, or even if you would have taken a long position on Thursday, you would have still had enough, I guess, breathing room, or to keep this to recognize this is really going long. It's crossed over your line, keep taking it, and then as it comes clear to Wednesday, we actually crossed my line in the sand, and then the thing just blew up. This was making 200 tick days these 2 days, this Wednesday and this Thursday, and it crossed over my line in the sand. So the point I'm getting at is my day trading. I need to reevaluate so that I can swing trade and put myself in good positions. Because every time if you get stopped out, or you get out of trade for the day, you lose your position from the prior day. And if it's on your side, all you're doing is giving up. You're just giving up the own good position that you worked so hard to put yourself into, to push the button in the first place.
Mm-hmm.
Does that make sense?
Oh yeah. You're listening to Pop 29 here on Briguy's Tools of the Trade here on DayTradingRadio.com, and I'm following some of the comments in the room and trying to fit it into your commentary. So let me first ask you, when you say a swing trade, are you referring to something that you hold overnight into multiple days?
Yeah, I want to hold it for like 5 to 7 days. I want to
Okay.
get into it and add to the position for 5 or 7, because it really moves in 5 to 7 days. I mean, right now, so that 89.90 was, you know, 2 weeks ago. So it usually moves 5 to 7 days. So even from that 89, it pushed up, it crossed our line, but then it wouldn't push above that 95 area, and then it broke back down. But even at this 90 level where it broke down, I'm still at 89, at 86. I'm still in a good position this isn't really giving me a lot of fortitude to the downside. And then that overnight session, it actually touches it and then blows back up. But because I'm either wig out or I'm not holding my position for a longer period of time, you know, I just feel like I'm giving a lot up by fighting day to day when I could be in this, you know, just as many contracts from the 89 to this point right here, and you know, double and triple what I'm doing basically, with just by holding my original trade.
Mm-hmm.
Does that
Now,
make sense?
what about the risk of holding futures contracts overnight?
Okay. This trade right here at 89.90, I only had a 10 tick stop, so I put that stop on 10 ticks below my entry and I went to bed. I mean, if I get stopped out, and this was only one car,
Mm-hmm.
I'm not talking. I'm talking from this point here to this point here, have 5 or 6 cars on by the time you get to here, and then by the time you get to there, you got 5 or 6 cars on from this point down here. You're ahead of the game enough that even if it comes back down to here, you're just at even, or you stop it out in increments. Is that, you know, and profit from this lower point?
Right.
My point is, I'm going to start trying to swing trade like I day trade it and add to my position as it's going up or down, instead of just taking it for, you know, like, what's his, oh, the new guy, I can't say his name, Chari. You know, he took it for 50 ticks today, and I was short with him at 60, but then I took my profit too and just got out of the trade. Even though I'm still looking for a short position, I got out of the trade today. It's at this 60 level, right, when it really blew up. But even at the 60 level, the highest we made it to was that we wouldn't push back above that 86, where it's been, 86. The 96.27 is really resistance. Even the 96 is resistance. So I should have had enough conviction to hold my trade, keep that one car on, take my profit here, keep one car on, and then add to this downside, because that's what I'm looking for anyway. But I still don't have enough time to do it. I still don't have enough conviction to hold it. I'm still like day trading it and taking my profit and trying to start over tomorrow to just push the button.
Mm-hmm. Well, listen, you mentioned about stops, and that's understandable, but what do you do with the fact that you can't have a stop overnight? You might gap down or gap up on the new session.
Yeah, but the most I've ever seen it gap up is 30 cents. And the new session, and then overnight the session opens, like right now, it's open. If you put your stop in now, it's good till tomorrow morning.
Yeah, no, I don't mean from that standpoint. I'm just talking about a gap. Now you're talking experience-wise that it hasn't done that. It hasn't been that volatile.
No, the most I've ever seen push over is when it rolled over the contracts on a Sunday night. It pushed up about 45 ticks. I mean, it's all about managing risk. I understand everyone's issues with stops and accounts, and I mean, I'm just talking a normal philosophy, you know, for me. And then, you know, don't go in 100 cars, 1 or 2 or whatever it takes to add to the position, and just add to it as it goes up.
Yeah, and I just wanted to make that clear for anyone who's listening and watching the show, that they understand what's involved with that. So obviously for stops, you're going to use a good to cancel stop, not a end of day stop. And I'm assuming that if it did gap below your stop area, it would still trigger. Is that true?
Now, the way I understand it, if it blows by your stop after, like on a new hour, it just you got to come fill your own stop.
Yeah, okay.
If I understand it right.
Yeah, I think that is what it is. Yeah, because then it never hits your print.
So if it opens up and blows by your stop, you're going to have to readjust.
Yeah, I've had that with
I've
had that with an IPO when it's jumping around, and you can't. Your stop never gets filled because it keeps jumping around. And I've also learned that with gold futures, by the way. Overnight trading with gold, they have such a wide spread that you'll put a stop in and it can actually jump over your stop. It did that to me a couple times. I was like, all right, you're going to be like this now. I see how that is. Anyway.
Yeah. Which I agree.
looks like I was able to get Johnny's computer back up on the main screen. So if you guys are not hearing my voice, it's because you're on channel 1. So if anybody's reaching out to you and asking you what happened to the show, please let them know to switch over to channel 2. We're going to keep this a member-only show here with Pop29. So you did a review now of the last week or two. Is there anything else you wanted to bring out from those trades?
No, I mean, I'm just watching it to the downside. I really think that 97 is it's just completely resistance to the upside. To get anywhere above that, we got to get through the 97-27 area is my feeling. But like I said, I'm just looking for the downside right now. I think it's going to readjust back down to the, who knows where it goes after it loses 90, but that's what I'm shooting for right now.
What's your green line up there at 101?
That's just my marker.
Oh, okay. I didn't realize that.
Pointer.
Right. Sorry. It was sitting so still.
Well, we haven't pushed over 100 since last year, and then, this year, I can't remember exactly, but even last year when we hit 110, it hasn't pushed over that. So we've been in this $6 range since December.
Mm-hmm.
If you even if you get on the wrong side of the trade, if you have enough conviction in your account, and
cash
to let it play out, yeah. I mean, I'm fighting. I don't think I'm fighting it, but when when I just went through those emotions when I traded it Monday to the long side, I'm not a professional or anything, and you know how I'm just looking for I guess more of a, I don't know if it's easier or, it's still going to take the fortitude to follow through with it, but I'm looking for another way to not fight it every day, even though I like it and I enjoy it, but to give myself some breathing room, especially with another account.
I was going to say, are you getting bored with day trading?
No, I'm not bored at all. Trust me, I don't get bored at all. I'm just watching oil make these patterns and these adjustments, and once it gets to that level, it's almost like, once I pull back and I really look at the bigger picture, why aren't you taking and holding those trades? Why am I not still long after 89, 90? And when you pull back and you take a deep breath and you look at the overall bigger picture, it's like not going long on the ES. How do you not go long on the ES right now? It just that's the way it plays. I think I'm getting more to that point of watch it play, have patience, let it play out, and take advantage of when it plays out. Don't hesitate so much, like I did Monday, just trying to take that long play. I guess is more of my new, I don't know if you want to call it philosophy, or trying to trade a little bit differently so that I can make my life a little more comfortable, I guess.
Sure. No, and you have to change your trading style anyway, because as soon as you get accustomed to trading one way, the market's going to figure that out. it's going to change, and it's a chicken and egg kind of a thing. But I do believe that you can't get locked into any one thing. Like myself, I've been lately trading a lot of GLD and SPY, but it's not always going to be like that. I see traders in the options room; they're doing a lot of trading on Goldman Sachs and a couple other ones, but that's because those are the ones moving around right now, and eventually they're going to stop acting so volatile. There'll be something else to look at. So you have to kind of change either what your instrument you're trading or the method you're using. And in this case, you're actually talking about expanding your trading. So you'll still be day trading, but on top of that, you want to have these outliers, let's say, that are your runners, and let them help offset everything you're doing in between.
Yeah, exactly. Especially after doing the show and listening to the first show we did, and then I've listened to me and RPM and FT71 when he came in.
Mm-hmm.
I've listened to that I think 5 or 6 times, and every time I listen to it, I'm like, you're day trading, and because the next day, even this channel right here, I drew way back. This channel was established way back here. Well, anyway, I can't even go that far back because this is only 90 days.
Right.
But that channel came down and it hit that 89 level again, and not to, why not trade what you see, like Vester says. I mean, tier we hit once there, it hit, came down on that midday and then hit again. Why am I not on? Why am I up here with FT71 and RPM, fighting this trade? And even this trade, when I took this trade earlier that morning with Rack, I told him I was looking to short the 87 or the 87 level up there, and I didn't follow through with that, and every time I listened to that video, when I didn't add to that position, I got wigged out anyway because of the show, and I took it way down at 60, but I didn't follow through with my rules. I didn't follow through with my plan that morning at all, what I talked about with Frack. But then when I took it long, I was like, man, you just need to start, trading these better opportunities. I mean, it's an opportunity that I took, but I didn't hold enough conviction because I'm so stuck in my ways of day trading that I'm missing out on these opportunities.
Right.
And if I'm going to trade just oil or one index, I need to recognize these patterns and these trades and take advantage of them, especially if I'm not going to go out and get another part-time job and trade Apple or the ES. I need to concentrate just on one thing and start recognizing these better opportunities when they come up. I think that's more my point right now.
Mm-hmm. Mm-hmm.
So, and Trade for Pay is asking me about options, and that's like so far over my head right now. I don't even want to get into. I'm not ready to invest in options when there's so many different. I mean, I would love to be in an option at 89, and I'd love to be in an option right now, the put side, the short side, whatever. I don't know how options really work yet, but if I was doing options, I'd be on the short side right now.
Mm. Yeah, that would be an interesting way to do it. Not to get into a whole nother lesson on trading, but yeah, with options, you've got the long side and the short side, and without getting into all the different strategies there are, in this case, you could buy a put on CL if you wanted to go into your trade tab, and you could look at the prices right now, but you don't have to if you don't want to. I don't want to confuse your mindset.
It's not about confusing. It's about trying to digest a whole. I mean in the future, that's exactly what I need to be doing: is trading CL with options.
Yeah.
And looking for every way, the opportunity for me to make money with CL is my goal from now on.
Yeah, I mean, to be fair, you're describing having multiple accounts, so your hedging is with the multiple accounts, and also with having a long on versus the day trading that you're doing. So the options is another layer of the hedging. So obviously you have, for CL, you've got to choose your contract. So it looks like for maybe if you plugged in CL M3 instead of just CL, would that bring up multiple? I see that each contract has its own set of options, but
see, I have no idea with options and how you guys look them up.
Well, anyway, you have I just type just to do a /CLM3, and I just want to see if more information comes up. You just have CL.
Yeah, I just typed in CL.
Can you type in CLM3?
One.
All right, so that just gives you the one. So go back to CL like you had it. That'll be the right way to do it. And normally for options on regular stocks, they'll have each month, like you have here, June, July, August. They'll have different options for each one. In your case, in the case of futures, it looks like they have them tied to the actual contracts. So you've got your set of M3 contracts, your set of N3 contracts, and Q3 contracts. So if you expand July, let's say, because I think June it might be a little too short term, being it's 9 days. You see the 9 there that's after the month in brackets?
Yeah.
That's how many days.
9 days.
Yeah, that's how many days to expiration. So it'll expire, and you either make money or you'll lose whatever you put into the trade in that time frame. So if you want to buy more time, you go with July, which has 41 days to expiration. And if you want to buy on the put side, you want to stay somewhere close to the price. We're trading at, what, 95.42 now?
Yeah.
Of course, that's the M contract. The N contract is trading at 95.67. Still pretty close to where we are. You see that on the screen?
Uh-huh.
So on the put side, you want to stay close to the money. So either a 96 option or a 95.5 option. That's the column that says strike.
Yes.
In the middle. And then the right side is all the puts. The left side is all the calls. It actually says puts on the right side across those columns. So just for argument's sake, here you see it says a bid and ask of 258, 289. The mark is 273. That's kind of the midway point. So that would cost you $2.73 for the option. Now maybe Trade for Pay can answer this quicker than I can bring up the my own chart, and that is whether or not it's 100 shares or is it more with futures. That I don't know. I'm going to do a quick.
See, when you say that, when you do the options, you're not actually buying. You're just buying options that where the price is going to be in the future. You're not actually buying a contract, right? You're actually buying an option, separate. Is that right?
An option contract is a contract, and what you're asking gets into another level of actually exercising the option contract. And I want you to think about it in the same terms as a future contract. You're buying and selling a futures contract, but you have no intention of converting that into actual, oil or actual gold if you're trading gold. You know what I mean? I get that part. You're paying, I don't know what your leverage is, but let's say you're paying $1,000 per contract or $2,000 per contract. That's all you care about. And whatever, if it goes up to 2010 and you sell it and you made $10, that's all you care about. And to me, when you're starting out with options, it's the same concept. You don't care about buying. Whether I'm going to convert this contract into, Apple stock in the future or Google stock in the future. I don't care about that. I'm buying it today for $200. I want to sell it tomorrow for $210 and make $10. That's all I care about doing. So in this case, that's how you would be buying these contracts. Now I just did it on my own screen here, and it looks like options are based on 1,000 contracts. If you did Apple or Google shares, for example, they're 100 shares per contract. So futures are apparently 1,000 shares per contract. So that $2.74 contract would cost you $2,740 to buy.
And then we're predicting that the price is going to go down to the 94.50. Is that correct?
Yeah, well, it can go anywhere down, and it doesn't have to go to a set price, because you're buying a put, and if it does happen to go down starting today, all things being equal, then that will increase in price from $2.74 to $2.75 to $2.76, et cetera, et cetera. What you add in with your knowledge of options is what's called time decay. So we have 41 days to go, right?
Yes.
And you see that column that says theta?
Yes.
Theta is time, T for time, and it's -3. So it's actually, you're losing 3 cents a day on that option. If all things are equal, you're losing 3 cents a day. If the futures contract stayed exactly at 95.67 between now and the end of July, when that contract expires, or mid-July, whatever the date is, 41 days from today. So in other words, you can multiply 41 days times 3 cents.
So is that per option or per contract? Per 1,000 or per just the option?
You're buying one contract, so it's across the whole thing.
Okay.
If you bought 2 contracts, then your theta would change to something like minus 0.6 or 0.06. But all things being equal,
So let me ask you this: okay, so oil dropped off from 97, and I don't know if I need to go back to, but something like oil where it moves, if you buy this at the right time, even if it moves 100 ticks in a day, is this option worth buying? If I think it's going to tomorrow, I think we're going to lose the 95.41 and see 94.80 or 94.69 tomorrow.
yeah.
I mean, is it worth just buying it for a?
Well, I'll tell you what. Can I use your mouse? I don't want to take over your machine. I don't know if you've given me. I'm moving my mouse. Is it working?
No.
Yeah, it's not.
Now it is. Disappeared.
It disappeared.
Yeah, you're up.
Okay.
You're up on the
so then
left.
It's just a little delay. All right. So do you remember when oil was at 97? Yeah, I see it moving now. Do you remember the date when it hit 97?
Say that again.
Do you remember when oil hit $97?
Yeah, it's Sunday night.
That was this past Sunday night.
Yeah.
Okay. So let's do this. I'll go over to this Analyze tab. I'm going to use this Think Back option here. And let's see. Now,
you didn't know you were going to do an option show, did you?
Well, I still don't know if I'm going to give you the right answer, but I'll do my best. Because I really don't use this a whole heck of a lot. But I do like looking at scenarios. So Think Back will work for a couple of days. You kind of have to let a couple of days go by before this will work. And it's even give you little pop-ups about it. So now, let me see what date. All right. Obviously, we can't go to Sunday night. You can't buy options on Sunday night. You'd have to wait until Monday morning to do that. Now, try to click the question mark to close this introduction. I don't even see a question mark.
I don't see it.
Oh, this is the question mark. There it goes. All right. Please turn off help. Thank you. All right. So, this is telling me May 6th. So I'm looking at May 6th. Give me a second.
Which was Monday.
Don't want to cough on the air here. All right. Now, it's giving me, I don't know why it's got 2009 options on here, because who cares about 2009? But let's try to find the correct CL. All right, so here's the July CL that we were trying to look at before. And I need to kind of readjust the screen here a little bit. Let's get rid of this P&L for a moment and expand this a little. And we're looking at 4 strikes. Let's change that to something like 10 strikes. And then I'll zoom this down. If I can get this to cooperate. Okay. And it's not giving me the right strikes. Let's make sure I'm looking at the right contract and say M3. I don't know if that'll make a difference, but at least it cleans up the screen a little bit. And I've got 10 strikes. I don't know why it's only giving me 42s. I mean, that's kind of silly. So I'm going to say all so I can kind of look at the 90s. And I'll have to scroll.
So is the strike the dollar amount?
Yeah, in other words, they're considered separate contracts. So in other words, the $95 put contract is one contract. The $95 call contract is another completely different contract. So we kind of show them next to each other, but it's a different contract. You could buy a 95 call, you could buy a 95 put. And then every equity is different. Some of them go by half-dollar increments, like CL here. Is it going in half-dollar increments? Sometimes it's a single-dollar increment. If you look up Apple right now, it's in a $5 increment. So you can't buy a $401 contract. You'd have to buy a 400 or a 405. And it's all to do with the market makers, whatever they decide to write up on contracts. All right, so here is May 6th, and the $97 is about where we were trading, right? Now, unfortunately, this has given me end of day information. If we wanted to do more than that, we'd have to go and use this on-demand feature. And I don't know if 2 days ago is enough time. Usually that's more than 2 days ago. But we're going to go through this exercise, and if we can make sense of it, great. If not, let's not stress about it. But consider that at the end of day, Monday, this was trading at, let's call it a mark of $2.18. Okay? Now it's telling me it's not tradable, but that's all right. We're on a think back section anyway. So I'm going to write that down. So 218 CLM3 97 put is $2.18 at the end of day Monday. Now if I change the calendar here and go forward one day to the 7th, and looks like I lost the Julys, and that's because it's not M, it's N, right? So let me go to N, and let's scroll this down.
So when you buy that put at 97, you're hoping it goes where? Is that what you're going to tell me here in a minute?
When it comes to options, there's a lot of reasons why you would buy it or not buy it. So let's just start with the basics and just show you what it is from one day to the next. Okay? So here's day 2. This is Tuesday, May 7th. That's today. End of day today. All right? So not intraday. It might have gone up, it might have gone down. But just at the end of the day, the 97 put is now trading at $3.49. Okay?
Okay.
So 349 minus 218 is $1.31. And because we're dealing with options contracts, that's a $1,300 profit.
How much?
$1,300.
And that's off one option, right?
That's off of one contract. So you would have to lay out $3,490 on Monday, and then if you sold it, I'm sorry, back that up, $2,180 on Monday, and if you sold it today at the end of the day, you would be selling it for a $1,310 profit. Now, I'm sure they don't always work out that way, but we just so happened.
Somebody's eyes just lit up.
Yeah. But we just had. What did you have? Basically, $1.50 move.
Yeah, from 97.
Now
today's low was 94.80.
Yeah,
off the 97. Yeah, basically. But that's what I mean. The thing moves 100 ticks a day. I mean, can you buy these things midday, or do you tell me I have to buy them and sell them at open and close?
No, you're definitely buying them all throughout the day. Absolutely.
Because there's days where it hits a midpoint, and you know it's going to go up 100 ticks from even the midpoint, or vice versa. I mean, there's days like that where, I mean, it moves $1 down and $1 up on kind of, I don't know if I want to call it a normal day, but sometimes it'll average out that way for 4 or 5 days straight.
Right. Okay, I'm getting a different answer here, so I want to make sure I'm looking at the right contract, because now this is telling me 346, not 218. And this is what I thought was going on. This we had an M in here before, and let me make sure. Was I looking at the wrong? I think I switched contracts on you during this conference here. 97, 218, I said? Yeah. So I got the wrong contract in this evaluation. And that's
so looking up the price like you just did, whatever you buy it at 90, let's just say 97, that's the same option at 97. I'm still holding the same option at 97. It's just a matter of whether or not it went up or down, right?
That's right.
Is that
Yeah, exactly. You're holding that single option in your portfolio as if it was a stock or a future or whatever it is. It's got a name. That's why it has this /LON3 on here, because apparently this is the symbol for the option. Now, before we go to
it's
the
that
next
option
step,
at that 97 level. So that's the price I'm buying it at that 97. Wherever it ends up at the end of the day or in midday, to the far right is actually what profit and loss is.
yes. Now this is 346, right? So
Yes.
forget what I said about 218. I was looking at the wrong contract. That was the M contract. But the CLN3 contract from Monday night to Tuesday night went from 346 to 349. And that's, again, we're looking at end of day. We're not looking in the middle of the day. There might have been a point in the middle of the day where you would have grabbed it at a peak. And then same thing, you would sell it the next day at a peak. And make more money. But just in this example, from end of day to end of day is a $300. Wait, one, two, three, a $30 profit. That makes more sense. So here's what I want to do next. I'm going to right click this, and I'm getting, it's not letting me buy it or sell it here. I don't know. You know what? You might not be authorized to buy options.
I'm not set up for options.
Yeah. So the platform is not letting me choose the option itself. I'm going to go over here to add simulated trades. I'm going to go over here to /CLN3, and I'm going to look at the July, and I'm going to scrunch the screen a little bit here so we can view it. And here's the 97, and I'm going to right click and throw it into a trade grid. I'm sure you've done that before. Okay, so this is the symbology for this option. It's a period. All options start with a period, and then because it happens to be a future, they throw a slash in there, and then LON3 is representing this particular option. L, I guess, for oil, O for option, and then N3 is the month, and 2013, and then P97, so it's the put. And here, if you look on the right, it spells it out for you that it's the CLN3. It's a leverage of 1 to 1,000 contracts. July 2013, 97 put. Okay. Now that I have the symbology here, I'm going to copy that, and I'm going to go ahead. What were we going to ask?
So when we buy this, or we're gonna put it, so we're gonna sell it, and so today I made like $300 supposedly, but the longer I hold on to it, I'm losing 3 cents a day for the longer period. So even if I held on, hypothetical question, if I held on this till 94, but if I held on to it too long, my time into it could actually get me to even where I really wouldn't have made any money.
Yes, that could happen.
Okay.
And that's where choosing the right strike price, that's where choosing the right month, because obviously you don't need to buy the N3, you could buy the M3, 9 days to expiration, and things like that. What I want to do is I want to see what the value of this is over time. So if I wanted to do a new chart, a blank chart, can I just come over here to charts?
Yeah, just go down to the left.
Go down to this one here?
No, up to the top to charts.
Oh, you're in a flexible grid thing, that's why. Okay. Can I overwrite this one?
Uh-huh.
It won't mess you up?
Nope.
Even if it's linked?
It won't mess me up.
Won't mess you up. Alright, so I'm going to paste that symbology into here. And it's not doing it, so I'm going to hit Control V and hit Enter. And we're looking at a 4-hour chart, right?
Yeah.
All right, I'll leave it at 4 hours. Now, obviously, all your indicators are showing up on here too, but you could look at the price action. So from I don't know if I can't really move that over. What are we looking at? Oh, 180 days. Okay. I guess I can't really go further to the left because this contract probably doesn't live that long. It probably just came out anyway.
They're only 30 days or 40.
Yeah. So
30.
Yeah. So here's Monday, and it opened up. This is a put. Okay, 97 put. I don't know what oil was trading at Monday morning at 9 a.m.
It was around. I'd have to move my mouse to see.
Go ahead.
Exactly.
Go ahead and move the mouse.
It looks like it opened up somewhere around the 95.26.
Really? So even though it hit Sunday at 97, it came down to 95.26?
Uh-huh.
All right.
Well, lost 200 points. I shorted it in the middle of that at 5:30. Well, yeah, 5:30 my time.
Okay. So
that's what I mean about it moving so much. I mean, I wanted to. Yeah, that's what I mean, it blew up almost 100 points from Sunday night to the 97.17, and then we lost 200 ticks.
Mm-hmm. Mm-hmm. Well, here's what I want you to take notice of. So first thing Monday morning, the 97 call or 97 put was trading at, and I'm trying to take back over your mouse here. It was trading at about 319. Okay.
Uh-huh.
And these are 4-hour bars, so you could see how it came down during that second hour. I guess this red hour is the first, or red candle is the first 4 hours, and then it's jumped up the second session of the day up to $4. So with that understanding, you could have bought it in the first half of Monday, somewhere around this 311 mark. Let's use the high point of $3.15. Okay.
Okay.
In the second half of the day, it was trading as high as $4.05. If you waited until Tuesday, now it hit a high of, in the first half of the day, $5.58. Okay. And then it even peaked out, it looks like, at $6.72.
Yeah, I went back up to the 96.27
before coming back down. Now, I'm looking at the Monday and realizing I think I went to the prior week. That's April 2nd. Over here is May 6th.
Yeah, you're right there. That's the last 2 days.
All right, be more helpful if we looked at the right days. So here's, all right, so this is May 7.
No, I'm not sure exactly what you're looking at, to be honest.
Yeah. Let me look at the daily and see what kind of a difference that makes for us. All right.
Basically, that's just the contract that expired from opening to closing, from opening day to when it expired is what this is showing. It was what time frame you're in, right?
Yeah, but
it's a 30-day contract.
No. It's from whenever they start writing the contract. I don't know for futures contracts when they start writing the contract.
Sorry, that goes all the way. Okay.
But
that
from
goes
when
back to February, this chart, but okay.
But from when they close, yeah. So there you go. This
I'm
contract.
just trying to figure out what you're looking at. I can't. I mean, it's so. Anyway. Okay.
Right. So let me back up. Now that I follow your charting here, this is from February 4th, back on the left.
Yes.
February 1st, actually. So apparently, on February 1st is when they started writing contracts for the N3 crude oil.
Okay.
Okay? It's a contract on a contract. And from back then, they originally priced it at whatever this candle is, which looks like around $4.40 or so. Now, I'm not going to go back and figure out what oil was trading at February 1st, unless you know off the top of your head.
No, it was no.
Let me go to my other screen here. I think I can. Here's February 1st.
What I'm starting to look at is that if I can buy a contract 90 days out in advance, giving me plenty of, depending on the expiration, how much I'm going to lose a day.
Yes,
okay.
You can. And I'm looking back, and it was trading about 97.5. Okay, so that's back on February 1st, and here the option contract this is again on the put side, was trading at 4.4. So that's $4,400 you'd have to put into this contract. All right, and if the contract, or the oil in this case, what we would consider the underlying, if the oil CLN3 finishes over 97, then you're losing all the $4,400. If you can follow that logic, because we're buying.
I follow it. I'm just
yeah.
Yes, I get
but
that.
Now you can just follow the candle, and you can print this out and look at the daily chart for oil and see what it did from February 1st until recently, and you'll see. I look at it around March 1st. It went down to that 89.35 level.
Correct.
And the contract here on March 1st is, try to figure out where March 1st is. All right,
close.
you know what? It kind of gaps. It's from February 21st. It gaps over to March 14th. So what I think that tells me is that people weren't even trading the option every day. That's one of the reasons why the this candle chart looks the way it does, because there's not a lot of volume. There wasn't a lot of trading going on. Based on your volume profile, you can kind of see where the peaks and prices were. $4.50, $4.90. But anyway, just look at this as if, I guess I clicked on your screen. That's why it keeps trying to draw a rectangle on me. This is where the price went. So it started out at $44.40, peaked at $6.72, currently trading here at $3.59.
Okay.
And just as the basics is that, yeah, whenever you bought it, you wanted to finish under that price. Now, to add on top of that is you got to look at what's called the break even, and so that means it can't just finish at or below 97, because you have to consider how much money you put into the trade. So it's got to finish.
Not only that, don't you have to put in the time that you've been in the trade and subtract that, whatever that amount is, from each?
Yeah. Now that's going to be over in this screen. I'm going to take the 97 and I'm going to simulate us buying one of them. It's defaulting to 10. Let's put that down to 1. Oh, I clicked too many times. All right. So there's 1. And then I'm going to switch to this risk profile. And here's the graph that people hate to look at, but when you understand this graph is when you'll start to make money. Look in the lower right corner. See these dates?
Yes.
All right. May 7, the white line is today. Let me move my arrow out of the way so it stops changing on the screen. May 7th is today, and that's the white line. June 18th is the expiration date of this contract. That should be 41 days from today. And that's the red line. So what happens is, as we get closer to expiration, that white line will start to straighten out and match up with that red line.
Okay.
And I could show you that by changing the date on the screen. Here's May 7th down here. I'm going to start clicking on that May 8th, May 9th. And the longer I click on it, you watch the screen and you'll see how it matches up with the red line. See that? And now it's gone away because I went past the expiration date.
But that's taking into account the time in it that you're getting charged for holding the option.
That's right. With the price staying,
right?
Yes, with the price staying exactly the same, that's how you're going to be losing your money by it expiring that way. Now, where it says price slices, we've got the live price 95.68, so that's this vertical dashed line, and then it has a plus 10% move to the upside and 10% to the downside. That's these other slices. So you can go into the set slices button here and you can choose different things to be your slices. You can pick break even, you can pick what's the symbol here? Starts with a D. I can't think of it right now. Deviation, standard deviation. You could pick one standard deviation, 2 standard deviation, however way you do your analysis. Now, if I do break even at expiration and just deal with the one line, okay, what this does is give me the 93.37. That is when you're going to make zero money. See where the red line is on the $0? Okay?
Yes.
So that takes into account the price of the option that you're paying. We said $3.46. So I'm going to adjust this manually to $3.46, and pretending that was the price you paid on Monday. So what happens at expiration is that the value of oil needs to be below 93.37. Now, if you think it'll do that in 41 days, then you'll do fine. Otherwise, you're going to finish up on the right side of that dashed line, which is, as you notice where the red line is, it's all under the 0.
Say that again.
See the 0 on the left?
Okay.
Okay. Now I'm going to hover my mouse right on the dashed line, and if you look to the left and see the date, the white and the red date.
Yes.
Okay. The dollar amount next to it is your profit.
If I get to that point.
So yes, if oil is trading where I have the vertical line at $93, I'm trying to get it to stop at 37. It's kind of at 38 right now.
Yeah.
But your profit is $163. Or I shouldn't say your profit. That's the value of the contract, $163. You spent $460 for it. So you can see how that's not very helpful.
Yes.
So when you move it to the right, you see how it hits a point and then it flattens out?
Yeah.
So this is the most you can lose, $3,460. You see how it starts at the 97? 97 was the strike price that we chose. So if oil finishes at 97 and above, you would lose the full $3,460. If it finishes below 97, then you'll lose less, but you won't make money until you get to the $0 mark. So there's where your theta is, between this 97 and this 93.37 is where you need it to, that's kind of your cushion, let's say. But if it finishes below 93.37, now if I move the line to the left and you look at the red date and the red dollar amount, that's your profit over and above the 3,000. So you'll make, let's say if it went to $92,
Yeah.
then you made $1,500. If it goes to
And
$91,
then I would just minus the time in the trade from that price, or that's already factored in.
that's
still?
factored in, yeah. And your 3,000 is factored in, so you'll get your 3,000 back plus another $2,500 if it's at 91. So all I'm saying is this is where you can use this Thinkorswim to play around with the numbers and see what it comes out to be. You can add the trade at the bottom. That's what I use this Add Simulated Trades option for. And you could play around with the strikes. I have the 97. You know, you could say, well, what if I got the 96 half and change the price? All right, 336 instead of 346. And then look at the graph and see how it looks different. Now I can go to 93.37 and instead of 93, what was it, 07 before?
I think so.
And then you could say, all right, what if I got the 96 strike? I'm just going to unlock this and lock it back up again. So we're paid 311. Anyway, I could sense that I've crossed the line here by getting a little too confusing. So,
well, it's not actually. That's probably the best illustration I've had yet because it's actually in front of me.
Yeah.
I'm trying to wrap my head around whether you buy I mean, how do you decide to buy a? I guess you play with that chart. Whether you decide to buy a 97 or a 96 or a 97.50, you just play with it till you decide where you want to be, right?
Well, you do, but this is where the Greeks come into play. And I'm going to change this option here on the,
now
on the
you're
screen.
getting into the terminology that scares me.
Yeah, and this is what a lot of people, they do get scared on this. But this is when you do get your head wrapped around it, this is when you'll make money. Now, to start off, and I still use these basic rules myself for the most part, and you'll get differences of opinions from different traders on what the ranges are. But here's the theta is here. That's a Greek, so you already understand that Greek. So you don't be too scared from that point. And you could see all of these you're losing 3 cents a day, so that's fine. Okay, but now we get to delta. Notice these are changing.
Yes.
All right, delta is, think of dollar for delta. Delta is how much the option price changes for every dollar that the underlying changes. So in this case, if we decided to buy the 96 contract, and I'm just going to highlight it, and the delta is 50 cents, what it means is if oil goes from 95.68 right now to 94.68, so it changes by $1.
Yes.
Then this bid and ask will change from 280 to 330. It'll change by 50 cents.
Okay.
From 280 to 330, and this will go from 313 to 363.
So at that time, I would own a better option. Is that, and I'd want to
it'll be
somebody else.
It'll be worth more money, right?
Yeah.
And then you could sell it. You made 50 cents. But if you look at the other ones, you'll see if you owned the 95.5 strike and oil moved $1, then you're only up 47 cents instead of 50 cents. So you're paying less per contract, but you're losing the privilege of that extra 3 cents. And if you bought the 95 and it moved $1, then you'd only gain 45 cents.
But if it moves against me, I'm in the whole 45, correct?
That's right. It works in the other direction as well. So that's why as you go further in the one direction, then it gets closer to parity. Eventually you'll get a strike price where it's almost close to 1. I don't think you'll find one this far away, 41 days away, because this is just one factor. Obviously the theta comes into play also, besides the delta. Okay, so what I learned.
Something popped in my head. Can you actually add to an option position like you can any old trade?
Absolutely.
Like if I would have bought these puts at 97, and then tomorrow I think we're going to lose the 95 to 94.27, I could add to it.
You can, yes, but here's the thing: when the option moves, when the underlying moves away from the strike price. Now in Thinkorswim, let me turn this off. In Thinkorswim, it colors this in with you have the black on one side and it's like shaded over here. Okay, this is giving you the dividing line of the current price of the stock, of the underlying. Okay, so since CL is 95.66, that's why this line is between the 95.5 and the 96. All right, everything shaded is called in the money, and what that means is if you're on the put side, obviously you're wanting the crude oil to go down in price. So these are everything above the current price, 95.66. So that's why 96, 96.5. These are all above it, and that's why they're shaded. Same thing on the other side. On the call side, everything shaded is below the 95.66. What people do sometimes is you own the 96 today, and then oil moves to $98 tomorrow, and they buy another 96. Well, that logic doesn't work with options, because tomorrow the delta on this won't be 50 anymore. It'll probably be something like the 42.
Okay.
So even though you're doubling your option and therefore lowering your average, you're not helping yourself because you're also changing your delta. Your delta's already gone down to 42, and then you're adding on top of that, so you're kind of putting more pressure on that 42. This gets into the graph, and you can look at the graph and go through some examples. I know you're good at doing that, so in your studies you can play some scenarios out and see what happens. So in that case, it would actually be more beneficial to buy a 98 tomorrow, and if you wanted to add to your position. If you decided to hold on to the 96, that's fine, but don't buy another 96. Buy a 98,
Yeah.
because the 98 will also be at a 50 delta and will pick up speed as it moves downward. Okay?
Got it.
And that's one way to do it. Another way to do it is getting into where you can actually sell these, not just buy them, but you can actually sell them as well. And now you combine a buy of 96 and a sell of a 95, let's say 95, and you're creating a window. Let's say I have a 96 put here, and if I sell the 95, let me change that to a 1. So these are even. 3, 2, 1. Go back to the risk profile, and you'll see what I did now is I capped not only my loss, but I also capped my gain. Okay? But the difference is I don't have to spend the full $3,000 because I sold one for $2,300. So my, adding that together, I only spent, what is that, $800 or $750. Well, actually, I can put my mouse on the chart and it tells me with the red line. The most I'll be out is $750 with this trade, and the most I can make is $250. Now, I just pick strikes at random. I don't know if those are the right ones to do, but this is another way to do options where you can structure them together. And again, if I move the date, you'll see what the white line does is it starts to bend to match the red line as we get closer to expiration. I went too far past the date.
Oh, that's kind of cool.
Now, the other things you can get into with the software are these shaded blue areas at the top, and these have to do with probability of expiration. So, there's all kinds of math involved with options to figure out what's the probability of it expiring above 93.37 versus below 93.37. And if we took our slices and did them in deviations, which I know, Epic loves standard deviations. So I did the slices. I guess I did it too far out because they're off the screen. So let me change it to 1 standard deviation. Yeah, that's better. So now we've created 4 zones with the probability of expiring above 95.64 which is the current price, is 32.5%. Below it is 35.5%, which tells me that there's priced into the price of the options is already a downward move because it's slightly more probable to finish down here. And notice what 1 standard deviation gets you down to your channel line, 87.72. That's within your channel, isn't it?
Yeah. So they change these every day. The options, the strike price. It's a day-to-day thing, right?
Well, yeah, there are buyers and sellers, so you're going to have the bid and ask changing every day. But there's also what do I call it? Like a statistical formula that the pricing comes from. That's down here. You see where it says model and it says Berkshire Stensland? Okay?
Yes.
If you Google that guy, or these are 2 people, if you Google them, you'll find a formula where it takes the price of oil, and it takes the days to expiration, and it takes even the interest rate. You notice the interest rate is here at 1/4%. So as the interest rate changes, that also affects the value of the option. And there's a few other things, and it's a simple formula. If you wanted to take the time, you can do the math yourself and arrive at the option price of what it should be. But the next thing that gets added into the mix is volatility. So in other words, if somebody decides to bomb an oil plant, then obviously the price not only of CL was going to go up, but the price of all the options are also going to increase by some kind of exponential rate. And then once they put the fire out, you know how you've probably seen this. How long does it take CL to start to drift back to a norm after they put the fire out?
The next day, once they stop shooting missiles.
Yeah. So same thing with the options. The options in some cases will actually react quicker, depending on some other factors. But the volatility could spike up. These options can go, instead of 3,000 each, they can jump up to 4,000 each. If oil is moving up, let's say 50 cents, these might go up $4 or $5,000 instead. And that's another thing that you can play around with, where you have the add simulated trades. You can change this layout here. One of these other choices is the theoretical price. When you pick that, it changes what's in the middle, and now you can actually predict tomorrow's options prices. So, for example, I'm looking up here, and
so I could actually go out and say, I'm going to get down to 94.89, and from there we're going to pop up, and I can do all that right here is what you're telling me.
Yeah, you could. And you could adjust this. Like today, this 95 option is $2.52. You could say, well, what if oil went up $2? And then I don't know if I got to hit enter, because it didn't change. Oh, the theoretical price, not the mark. Let me put that back to 0, because I was looking at the wrong column. Look at the theoretical price, 252.
Yes.
If I wanted to do a little example, say, what if oil went up $2? Notice the option went to $1.73. So that hurts you, because we're looking at puts.
Yes.
But let's say oil went down $2. So from 252, it goes to 352. And if we go back to the Greeks, that was a 45 delta. So it moved a full dollar for $2, right?
Yeah.
And when it should have been 90 cents. So what was the extra 10 cents? Well, that's part of that is the Theta, because it didn't click over by a day. I didn't change it to tomorrow. I had it at today. I should have picked the 8th. And then the minus $2. So now it's $3.49 instead of $3.52. So there's your 3 cents. So we're still missing another 7 cents in there. But that missing 7 cents could be made up from the volatility increase, with the fact that it jumped $2 in one day. That's kind of a big move, right? 200 pips in a day.
Yeah.
So the
not unusual though.
No, not unusual. But that's why the price would be not exactly the same number than the exactly 45, the Greek of 45 delta times 2. Anyway.
But still, this goes back to what I was talking about earlier, which is just staying focused on one index and using all the tools for that index to make profit. I mean, if I could learn how to do the options, a midday trade where I think it's going to blow up 100 ticks, I mean, it's all right there in front of me. And once I actually understand it and can just flow with it, instead of like trying to, I don't know, get in on the long or the short side in the middle of the day, even though I think it's still going to blow up. Once you're already burnt out, I'm not putting as much, risk out there if I buy an option, but I still think it's going to move up or down.
Right. And I see Trade for Pay is mentioning the Gamma and the Vega. I didn't get into the other Greeks, but these are all...
Trade for Pay's been saying lots. I'm trying to keep up.
Okay, I haven't been reading everything, but I see him. I guess you've been reading all his comments. I haven't really been reading all of them. because I was looking at the screen. But
I'm not ignoring anybody. I just don't have control right. Maybe you should come trade for me tomorrow. Makes it a
All
lot
right.
easier.
I'll give you back control of the mouse, so stop touching the mouse. But you know what? The concept of trading options on futures contracts is something that I'm actually working on getting a guest on the show to talk about that. Because here in this example, we looked at oil, and the options contracts for oil are pretty limited. You have the 1 month for... I'm sorry, you have like the CLN3 contract only has one option for it.
Do you think that's just because it's volatile, or because it's a future, or what?
Yeah, well, it is because it's a future. They don't write. You know what? I started a sentence, and as I say it out loud, it doesn't make sense. I guess they really only would write one set of contracts per the future contract, because you got the M3, the N3, and the Q3. That's it. You got those three to choose from. But if you wanted to trade, like, I don't know what corn is. Do you know what the symbol for corn is?
I don't. Wheat's WZ.
Okay, let's look at wheat. And
Or ZW. Sorry.
yeah, I guess it didn't like that one. So let's do ZW. Yeah, waiting for data. I never liked that. Okay, so here's. All right, yeah. This is what I was expecting. This is what I was expecting.
Yeah, no volume.
For wheat, you have the N contract, which is July, but it gives you a June and a July contract. Then you go to the next month, U3, which I guess is what is that? October?
It says August, or yeah.
Okay, I don't remember what the U is, but the for the U underlying contract, you have August and September futures contracts or options contracts. Then you have for the Z contract, you have December. For the H contract, you have March next year, and for the K, there's May, and for the N, you have July. So oil, we only had three choices. For wheat, it goes into next year. So this would let you take in macroeconomics, for example, and say, well, you know, we had a drought in the Midwest. Maybe you consider there's a shortage in India or wherever else they're growing wheat, and you think that it's going to have an effect by, let's say, next spring. So now you can come down here to March contracts, and you know, you think you're going to go from the 700s where we are now, and you're going to go to 650, and this gave me back to the eight strikes. So let's go somewhere in this range. So you can actually price out a put. Now it does say 707, right? Am I looking at the right thing? No, that's not the H4. I guess the ZH4. And just so that I can get the last price. Was it at the top here? You know what? I think...
Oh, you're starting to lose me.
All right, I'm just trying to expand this. Okay. The H4 is March of next year. Okay. So here's what it's currently trading at, $750. It's $50 more than the current contract. They're already figuring it'll be worth more then. And if you think wheat is going to be a shortage, well, it's already priced in a $50 increase by then. But anyway, under this logic, you'd want to get a call. And I like to get deltas that are at least over 45. So in this case, anywhere from 47. I also don't like to be too far out of the money. So let's just say for argument's sake, I like the 55. So I'm going to buy one of those. Yours is defaulting to 10. I'm going to change it to a 1. And then I'm going to go over to my risk profile. And here's my risk profile. So if it finishes down below 750, I'll be out my full nut, which is $3,218. And it looks like when you buy one of these it's only leveraging 50 instead of 1,000. Okay, see the 1 over
So
50?
when you buy it further out, does the option actually cost you less, or is it this?
No, usually it'll cost you more because of the time. Remember, it's 3 cents a day in that one example. So you're going to be paying that 3 cents a day. Forget about the strike price. Forget about where it's moving to. You're paying 3 cents a day for the insurance. You know, it's like when you go on a vacation and you want to pay for, the plane insurance. It's going to cost you a certain amount of money. Once the vacation's over, that contract's worthless.
Got it.
You're only paying for it for the time of the vacation. So in this case, the option will cost you $3,218. But if you're right,
so wait. When you say that, I'm buying the option for X amount of dollars, but that insurance I'm paying for is basically at the end of the day, once the option's up, that's the most I'm going to lose, is what you're telling me?
yes.
Okay.
If you bought the contract, okay.
So I know when I buy an option, once it expires, that's like my stop. I'm going to lose that much if I get to that point, right?
That's right.
Okay.
That's right.
Okay.
Your break even is up here where the zero mark is. So you need wheat to get up to $814 in this example before you start making money. Now, if it finishes anywhere in between the 814 and the 750, this little vertical angled 45-degree angle red line, if it finishes anywhere in that range, you could sell your contract. You won't make anything, but you'll lose less, if you can follow that logic.
Oh, I understand that.
You need to get over that mark before you actually start profiting. And then, since it's a call, this kind of goes to infinity. So if oil happens to go, up to $900, you can see how it redraws it. And you look at the red date on the left side, that's a $4,200 profit. Now, I don't know the history of wheat, but you'd have to
last year
factor
it blew
that
up. It blew up last year.
Okay, but you got to also understand the difference between wheat and oil. Oil's contracts, one option contract leveraged 1,000 futures contracts. So you had to take the dollar amount we were paying, $3.49, and times it by 1,000. In this case, we're leveraging 50. So it's $64 times 50, not 1,000. That's why it seems like, wait a minute, why is that $64 instead of $3? You got to do the math there, and that's why it's 3,000. It's $64 times 50. It's getting you the 3,000.
Okay.
But anyways,
so is that insurance? Is that all you get charged when you buy an option, or is there also the commissions?
Yeah, there's commissions. Now, if you have a standard account with TD Ameritrade and you're paying $8 per trade, you would pay $8 for the trade plus 75 cents per contract. That's their standard pricing. You might negotiate different prices, but you would pay $8 for the trade plus 75 cents for the commission, and then when you go to sell it, you're going to pay $8 for the trade and 75 cents for the commission.
Okay.
And that's why if you buy them in blocks of 10, for example, you'll save yourself the trading price, because you're paying once for that $8, and then you're just paying the 75 cents times 10, $7.50.
Got it.
And different brokerages have different pricing structures, but that's the basics of that. But again, you can play around with your strike prices here and see what different amounts. I'm already, just brought something to my attention, the fact that the March 14 contracts are $50 higher than today's contract. That's phenomenal. Because it's trading at 750 for March 2014, when the July 2013 is 707. That's a $50 spread.
Well, I figure July's the middle of summer, which last year it blew up because of the drought, and they all, yeah.
Yeah, but they're already pricing in an increase to next year, is what I'm saying.
Oh.
But this is something that one of the seminars I went to, and I talked about this on another show, is that you can buy these contracts on the staples, for example, and you can buy them, half a year away.
Yeah.
And figure on what you expect it to move. And, you're putting up $3,000 in this example. If you can do that with your portfolio, put $3,000, you can actually, in the examples that he gave, by the time you got to that, he's trading it, he's selling it before you get into the 30-day window. And this is another newbie lesson when you're trading options, is that you don't hold on to them in that 30-day window to expiration. That's why I looked at the ones that were 41 days to expiration. But theoretically, you would get rid of that after 10 days or 11 days.
Okay.
And that's because of the factors that press in on the price of the option become more complicated. And unless you're paying attention to those, you can easily erode the value of the option.
The longer you're in it, the worthless it's going to become.
Yeah. Well, because in that last 30 days, if
you're on the winning side, every day it's still costing you money. So sooner or later you're going to get to even.
Yes.
Okay.
But like if the white line is kind of straight, right? And if I click on the white line here, I got to change this because the date is like a year away. So let's go to like December 1st, 13. And you see how the white line starts to curve a little? It's not a straight line.
Uh-huh.
That's what happens when you get closer to the 30-day window. Now this expires February 22nd. So I'm outside the 30-day window right now. And see how the white line has a smooth curve to it?
Mm-hmm.
Now as I go to January 22nd and I get into that 30-day, that white line curve, it starts to arc at a sharper rate.
Yes.
If you're kind of understanding that. And that's where new options traders get a little hung up, because in that 30-day window, they've been watching it and it's been moving, maybe they're losing a penny a day or it's up a penny a day, and they think, okay, I'm still waiting for a big move. All of a sudden it gets into that 30-day window and it starts moving a nickel a day or a dime a day, and they're like, wait a minute, what just happened? Why is that happening? Well, it's because the Theta, which was at 3 cents, once you get closer to expiration, it'll change. It won't be 3 cents anymore. It might be 13 cents, or it might be 23 cents.
So they can actually change that even after you purchase the option?
They won't change it. It's just a fact of the formula that creates the price.
But it can change after you buy the option?
Yes.
Okay.
It won't be 3 cents all the time. I don't know if this... Let me see where I would...
That's just not right.
No, I mean, I'm trying to tell you, it's not that they change it. It's a fact of the
trading options, I guess.
Of the formula that creates the price. So let's go back to CL, just to stick in the same scenario, and let me use the July. So there's 41 days to expiration. Let me bring up all right, we have the theoretical price, but I want to see the Greek too, so I'm just going to add a column in here of the delta, of the theta, okay, just to have that one extra column in there. And let's minimize this trade grid so I could bring this up a little and move this down. And we're going to look at the price of this option. And
when you're sitting here at oil, because that's what I'm interested in, it really doesn't matter if I buy a 97 or a 93, as long as I'm on the right side and I like the formula across that price range. That really determines my risk, right?
Well, on one hand, it does. The reason you're looking at the Greeks is because of the value of the option. It's how can I explain it? If you're buying a new car and you're buying it at the peak of driving season and you go to buy insurance on that car, and let's say you are 17 years old. So the insurance company is going to look at those factors and say, oh, all right, you're 17 years old, you're buying your first brand new car, and you live in a city, let's say like San Francisco with the crazy hills, and they're going to say, all right, the price you're going to pay for insurance is going to be $5,000 a year. Now, all things being equal, let's say you had a 40-year-old walk into that same dealership, buy that same car, but he doesn't live in San Francisco. He lives in a suburb 50 miles away where the crime rate is very, very reduced. He's got no tickets on his history. They're going to look at that same set of scenarios and say, all right, your insurance is going to be $3,000. Now, they could both get into an accident, and the insurance company will still have to pay out. But the value of that option or that contract is different under the two different circumstances. So that's why you can't just simply look at the strike price and think, oh, I think it's going under $92, so I'll buy it down here. Because all things being equal, that's priced into this value already. The fact that this 92 is trading for $1.51 versus the 95 is at $2.50. It's a dollar difference of the option versus a $3 move on the underlying. It's already priced in to the formula that we're not going to sit here and do the math on. That's this Berkshire Stursgaard. And another one down here is Black Scholes. I saw Die Laughing mention it. You can change this to Black Scholes and it'll give you a different formula to come up with the price. But today, this is the price. And what I was going to demonstrate to you is we're going to leave the stock price at the same value. So let's say you bought the 95 at $2.52. I'm going to write that down. The 95 put at $2.52. May 7th. What happens on June 7th, a month from now? We're closer to expiration. Now look at that. Assuming the stock, or the oil in this case, didn't move a dollar, it stayed in the exact same price. 30 days go by, it went from $2.52 to $1.15. Now that's more than a dollar move. And if we looked at the Theta is 3 cents, that's more than 3 cents times 30 days. Right?
Yeah, which does what for us?
Well, I'm just trying to show you that it's not simply the value of the Theta that's coming into play. It's when you moved into that 30-day window of time, there's other factors that come into play in the mathematical formula, not necessarily somebody trying to pull a fast one on you. It's just of how the mathematical formula works. You're getting closer to expiration, so there's probability of it expiring versus probability of it still being worth something. And then every day that we tick by, it's losing now, instead of 3 cents, I'm looking at losing maybe 7 cents. That was an 8-cent move. That's a 7-cent move. That's another, what was that, from the 11th to the 12th was 87 to 78, so that's a 9-cent move. So it's kind of picking up steam each day. But again, if you looked up this formula, and it's something I actually mentioned to another trader about maybe wanting to do a future show on, is looking at that formula. And I don't know if we have any mathematical brainiacs on here that can help us digest it, but I wondered if it would help us grasp how the price is being arrived at by seeing how the different parts of it change, of the formula, how the different prices change.
Well, I think the biggest, what I'm getting out of this, the biggest thing I'm getting out of this is that if you actually understand whatever you're trading, and you can actually get the right the right strike price for where it's headed off of your, like my normal charts or whatever. If I think it's going from 97 to 94, if I can get the right strike price in the money, as you call it, then I'm more beneficial, not just understanding what the options and how it works, but bringing it all into the big picture, right?
Yes, you can. And keep in mind too that if you think it's going to 94, then you need to factor in the price you're paying for the option. So you if these are $2 or so, you might actually want to be buying the 95, because now you subtract.
That's what I mean about buying the right strike. Even though I think it's going to 94, it doesn't really matter. What matters is the right strike price for the direction where I think it's going.
Yes.
Okay.
Yes.
I mean, that's more important than the buying the right strike price for the direction it's headed, and the target you're headed for is actually what I'm getting at. This is more important than just buying what you assume the price is going to be. You need to buy the right strike for the target.
Yes. And then I'll show you something really crazy, which is these iron condors, which I'm going to sell an iron condor. And I just have to turn off the single ones and just keep the iron condor on. And let's see, is that the only one turned on? Okay. Move this down a
I
little.
have no idea what you're doing now.
I think I changed the date, so let's reset. Okay. So this, I'm just going to take a chance.
This is an iron condor option, right?
Right. This is a graphical view of an iron condor option. I'm going to change it down to 1 again, just to keep all things equal. And in the cases of an iron condor, you sell them, you don't buy them. You can buy them too, but in this strategy, you sell them, not buy them. So you actually take in a credit, in this case of 47 cents, or if we're timesing it by 1,000, you would take in a credit of, is that $4,700? Yeah, no, $470. 1, 2, 3. Yeah, $470. So this speaks to your example of pinning a price. If you think it's going to hit a price target by expiration, you can do that with an iron condor. It's buying a call spread on one side, or selling in this case, selling a call spread on one side and selling a put spread on the other side. It creates this graphic. So the most you're going to lose, if I hover my mouse here, looks like $30.
Yeah, when the option expires, right?
Right.
So does the Theta thing come into play on this kind of an option?
Yeah, well, Theta is always going to come into play, but what happens is because you're getting a spread, because you have a -1 and a +1, they start to zero one another out. If you're looking at the mathematical formula and you're starting to compare. I'm reading something. Cherry for Page just posted the link to the decay chart that I was trying to describe to you earlier, so you can check that out. But in this case, when you start to combine options together, then you're having a -3 cents on the one theta, but then you're getting a +3 cents on the other theta, and it creates what are called delta neutral strategies, because even your deltas start to zero themselves out. And in this case, you can create this window. Now this is nailing like one specific price, but you can stretch this out further. Let's make this from 96. Let's go to, just for giggles.
So is this a less riskier option to trade if you really are convinced with the direction? Even so, if it does go against you, I'm only going to lose 30 instead of 300.
This is,
because you're canceling each other out. Is that am I grasping that? Did I say that right or not?
Well, you're losing. You'll have to give back the credit as well. Actually, I'm kind of surprised that this seems a strange risk reward. You're losing $120 with the possibility of making $380. That's actually pretty darn good, if you ask me.
Well, yeah, that's what I was just trying to wrap my head around. You're telling me most I'm going to lose $30, but I can make $300, especially with oil if you get the direction right.
Yeah. Now we're looking at the N3 contract that expires June 18th, and if you played around with these strike prices here, I'm going to stretch out the put side as well, just trying to make sure I grab the right numbers. So let's go from 94.5. Let me just go to 92.5. And then from 95, we should go to 93.
So you're actually determining which side, or how do I say this? You're actually determining your put from dollar to dollar and your call from dollar to dollar, and then they're canceling each other out.
Well, the Greeks are canceling each other out, but they have a value that you're still paying for one and selling the other, and then Thinkorswim is doing the math for me.
But what I meant by that was, okay, we're at 94. Let's say we're at 95.50. If I think this is going to go down to 93.50, I apply that inside the formula you just did, and to get against me, then I think it's going to go the other way. Except I can narrow that down and say the most it's going to go is from 95.50 to 96. I only need 50 cents margin the other way.
Well,
Does that make sense?
Let me explain to you this way. If you can look at the graphic and you see the red line,
yes,
I've created a ledge up here, and that ledge is, in fact, let me change my slices. I'm going to set my slices to break even at expiration. This will help explain it. So the two vertical dashed lines are the two price tags where this trade I break even. If it falls between the two dashed lines, I make money. So as long as oil finishes between 92.69 and 98.81, I'm going to make money. I'm going to make the most money if it actually gets to this flat line up here. So that's kind of, if I hover my mouse, I figure out exactly where that is. But that, in that price range, that's $310 I can make, which is the credit that I'm getting. See the 31 cents?
Yes.
So if I pick this price target, and these are the right strikes that I want, I can actually keep this $310. If I'm wrong and I have to pay money instead, and the broker is going to take money out of my account, the most I can lose, let me move my mouse over here, is $190. Now, where did they get $190? The strikes that I picked are off by 50 cents, right? I went 92.5 to 93. You notice that?
Yeah.
And 98.5.
When you say you pick the strikes, that means that's the end of your expiration, or that's the end of your price range?
Nope. I'm talking about over here. I'm talking these strikes. I'm picking a strike. 94 and 93.5.
Okay.
Or 95 and 94.5. I could pick whatever strikes I want to build my trade. And then I look at my graph and I see if it's what I'm looking for. And actually, this is a 50-cent difference here. Let's do a full dollar. Instead of 99, 98.5, let's go to 98. And then take 92.5 and make it 92. Okay? Now I'm not going to make as much money. It's still the 310, but I'm risking way more. Now I can lose $690.
Okay.
So maybe going back to the half is actually the less riskier example here.
But when you go back to the half, does that the option still has X amount of time the option still has an expiration date, right?
Yeah. In this case, you notice it's still
get to that number and then reverse and go the other way. Or not.
This is where you're buying them all the same month. See, it's July 13, and these are all LON3s. So they all expire June 18th. So you don't mix up your months for expiration. That creates a whole different strategy altogether. In this case, we're just buying them all in the same.
What I'm getting at though is
expiration.
if it expires. Okay, so this option expires July 13th. If it gets below the 92.50 or gets below one of my strike prices, then what happens, or if it gets above one of my strike prices.
Yes, if it's below this 92.50 on expiration, then the broker's going to take another $190 out of your account.
So it doesn't matter where it ends up. All that matters is the expiration date and then where that actual number ends up.
Yeah, in this case, yeah, wherever the price of this ends up. See where the white line kind of reaches a peak somewhere in here.
Yeah,
that's where we are now. Now I'm going to do the same thing I did before. I'll change the date, and you'll slowly see how the white line starts to move and match up with the red line as we get closer to expiration. So for a while, you notice it hardly moves at all. But now that I get within that 30-day window, it starts to move a little bit quicker. But what I'm also going to explain to you is that if you decided to get out of this trade now, let's say May 30th, you don't have to wait till June 18th. So come May 30th, if this option is still trading in this range, or not the option, but if oil is still trading in this range, but maybe it's getting a little closer to the left side or a little closer to the right side, then you could sell it. Well, in this case, you'd buy it back. And, if let's say it was at $100, for some reason it jumped up on you, you can buy it for whatever its value is at that time, and it looks like you're going to lose $28 instead of the full $190.
That doesn't seem like such a bad concept.
No, it doesn't. This doesn't always work with options. It has to do with the prices that they're available for. It has to do with the volatility that's going on. And if you also need to have the buying power in your account. If you look over on the right side and you see where it says BP effect, okay?
Yes.
So when you have this trade on, you need to keep a certain amount of money in your account to let this trade ride. So it's going to affect your buying power. Even though you took in a credit of 310, they're going to lock up $800, let's say, for that trade.
Yeah.
Until expiration. Yeah. But that happens any time that you do a credit trade. I was showing you earlier, we were buying options, and so therefore you don't affect your buying power. It's whatever you put into the trade. But in this case, it's a credit trade, so they lock up some of the money because they want to be able to take out that $190 when the time comes. It's kind of silly that they lock up the full nut, but
yeah,
that's because in theory you can close one half of this iron condor where it'll go to infinity, and then the left side will stay open, and that's kind of why they lock up your money like that.
Oh, all right.
Anyway, I really digressed tremendously from what we were first talking about. And I said I digressed tremendously from what we were first discussing.
No, I mean it's all in the same guidelines where I'm trying to get to, which is use every, lack of a better word right now, and all the options I can to, benefit me.
Yeah, all right. Well, we want to benefit you. That's a good thing. And we want you to benefit us by telling us any cool thing too. As far as our checklist of things that we were going to be talking about, the last thing was to look at any swing trades, which I guess we did cover that.
Is to the short side. If I lose this, I'm really hoping to lose the 95.45 overnight. Okay.
So that means you'll be waking up tomorrow with a bias to the downside?
Header, I can't stress enough that $97 value is just such a header. Anything up there is to take a lot to push it through that, I think.
So you're saying peace in the Middle East won't be enough?
Say that again?
I said peace in the Middle East will not be enough for oil to go past 97.
If they shoot off a missile, yeah, that'll push it up. But, I mean, that's what it's going to take, is something, like that to get it above that, I believe.
Okay. I did a lot of talking there, and I didn't watch the comments in the room. So if anybody has a question that they want us to circle back on, please let me know. I lost my chat on my laptop, so if you guys send any messages to Briguy, I kind of lost it. But Briguy on air, I think, is still logged in. And, well, I don't even know who I am right now. Let me change my...
That's funny.
I'm going to change my nick back to Briguy.
Yeah, I don't have really... I mean, that line in that sand on the 15-minute, that's working out really... I mean, it's only crossed out 4 times in the last 30 days. And every time it crosses, it's good for $2 or $3.
Yeah.
If that matters to anybody.
I don't know if Average White Boy is still in the room, but I did see him ask a question a while ago that I wanted to come back to. And he was asking about the seasonal effect on oil. For example, gas generally gets more expensive in the summer. Now, you sound like you look at profile, you look at price action. I don't know how much you really care about what day of the week it is, or I mean, as far as the calendar goes.
The problem with that philosophy is we've had in the last 3 reports we've had so much extra oil sitting around. There's plenty to burn up. So so what if they start driving more finally because we can finally afford it? There's plenty of surplus out there, so I don't think that's really going to push the price up.
Okay.
In my opinion, but like I said, I don't. Unless a missile's going off, I don't care. Even the numbers lately haven't done significant. I mean, they give it a little. I mean, the last numbers weren't that hot, and they still pushed up.
Do you find yourself holding through the announcements?
And like JD, huh?
Do you find yourself holding through the announcements?
Yeah, I mean, every other time probably. I held last time, and I held the last 2 times. I held with RPM, and then I held this last time. So. And like JD said, it's its own monster. I mean, oil will do, I mean, it only trades 200,000 plus times a day. It's going to do what they want it to do, and all you got to do is be on the right side of that. I can't stress that enough. I really pay attention to the volume. I mean, if we get 10,000 shares to one way or the other, it's going to blow through those lines of resistance and those headers to whether it's the upside or the downside for the day. So,
okay.
I mean, that's my. I don't know. I'm kind of lost right now, actually.
I'm sorry that I went into so much detail with that.
Well, that's still sitting in my head. All those options, the way you guys. I mean, it's something that I mean. You guys are always talking about options and trade for pay and dial-in, but it's always about stocks. When the futures have so much potential, it seems like to the option side. I mean, maybe I'm wrong, but. I mean, it's something I'm really going to dig into more.
Yeah, I mean, for apples to apples, you're still dealing with the same thing as far as the Greeks go, as far as the prices go. The other thing I wanted to mention, since we were looking at the prices, and let me see if I can click back over to your Analyze tab, and that is the spreads. So when we're trading stock options, in general, the spreads are pretty close. So if they're off by 10 cents between the two of them, then or 15 cents, maybe stretch it out to 20 cents, then we might consider that worth buying. But here you can see already it's more than that. It's like 30 cents. And I don't know if other examples it gets worse than that, but that's why I think sometimes you might not find traders looking to trade these because they'll get nervous. If you bought this for $2,600, you're already down $300. Because of the spread. You don't have that. You don't have that situation with oil. You buy this for $95.68. It's a 3-cent spread. Somebody's willing to, buy it from you for 65. So in that standpoint, that might turn some people off, make them a little nervous about. I should reset this on you so you don't get lost when you come back in.
Oh, you're funny. Like I'm not going to get lost on this option page.
No, I don't want you to get lost over here. It's just got to be. Let's put it back to where it was. There you go. Have you ever?
That's what I mean. But when you say that, I mean to me, it's just oil. Once you wrap your head around it, the options are. the potential's there as it is the same way I day trade it. Once you actually aren't scared of it.
Yeah, and I'll tell you what, this is kind of crazy, but this looks like a good trade. I don't know. I'll have to digest this a little more.
Well, let me know.
That's,
I mean, that would be the ideal thing, is to figure out which option works best for literally the volatility that oil brings to the table, which is 100 ticks, 200 ticks a day. But on an average day, 100 up and 100 back to gap is normal.
mm-hmm.
I mean, even if you caught it midday for 100 ticks.
Yeah.
And could put like I've been trading the last month and a half, 2 months, by putting more cars on the table. To me, I feel like I'm risking less for a less amount of time. To me, it almost sounds the same thing with the options, except that I'm not going to have to put as much out there. It's to make it work for me.
Mm-hmm.
Does that make sense?
Oh, definitely. And I'm not sure that buying the options versus hedging your position with another account creates any more or any less risk. You know what I mean? It might just be, they might just be two sides of the same coin, as it were.
Yeah.
But I do know that they're out there. Die Laughing was asking about the deltas on the strikes, and according to here, a combined delta, it looks like it's around 27 to 21, depending on which side you're on.
See, I'm not sure what that means yet.
Yeah. Well, as I mentioned before, it's D for dollar. D for dollar. So every dollar that oil moves, this is losing $26. But on the other side, it's gaining $21. So it's a push and a pull. And because I did an iron condor, it's a push and a pull. And in this case, if it goes down in price, the push is stronger to the downside, because I'm losing $26 on one side versus 21, and that's if you look at your percentages. Again, they're already priced into the options are probability that this will move down. There's a 47% chance that this will move into this range, versus a 40% chance it'll move into this upper range. I find that to be a little telling already, whether you buy options or not.
Well, then not, but someone who's been watching oil for 8 months, I agree with that.
Yeah, well, that's exactly it. It's the same. You're seeing it from watching the price all this time. The options prices are based on that reality, with a couple other factors, but it's really based on that reality. The price over the last 30 days, and the price now, and like I said, the interest rate, et cetera, et cetera. One of these days I'll get that formula and we'll talk about it, and maybe I'll be able to tie it in to a spreadsheet or something so we could play with the numbers and see how it behaves. But you could kind of do that already here with...
well, I'm getting to the point right now where, Trade for Pay and they do their option shows. I'm getting a lot more out of actually watching you run it, whether it's my screen or someone else's screen, than I do listening to them just talk about it. I can actually see it playing out, versus when they talk about it, sometimes it's just completely over my head because I can't keep up with them.
Mm-hmm. Well,
that's been my biggest problem with options. It's just like that right there. You throw in percentage and then you throw in the date. This is just food for thought. But when they talk so much and so fast, it's just like, are you kidding me? Then you go from a regular option to an iron condor. And a butterfly. I just get lost. I feel a lot better about it right now than I have in a long time.
Well, I don't know. I don't know what to say to that. Thank you, I guess. And I'm
actually seeing it and watching you run through it and having my screen open. I can actually wrap my head around it.
I'm sure if we worked something out and Die Laughing came by your house and was able to show that stuff.
She owes me a date, so that's fine.
I'll leave that up to her to figure out how to fulfill that.
Yeah.
All right. So I think we covered quite a bit here, and I see Kumar is getting anxious to share some information as well. So maybe
I gotta go to football practice too. So
okay, all right. So thank you so much for coming on the show again, and I'm happy I was able to at least explain a few things additional. And I didn't get to show you, but for between you and I, the things that you showed on the previous show, I started to apply some of those myself with my gold trading, and even the was it the TEMA line, and then changing that to the stair steps instead of the actual line. I mean, all that has really helped me out, and I think I could do it a lot better if I focused more. But just from sit in front of the screen, waiting 10 or 15 minutes to find something set up, then get into the trade. I could be out of the trade in a half an hour and take 100 pips or 100 ticks or whatever we call it, and it's fascinating to me. I mean, what you described is something you can do daily,
helps, but in my opinion, to always all of it, bring it all together. So, what
was the additional indicator that you were playing around with? Do you want to say? Or you don't
that's
want to
say? It's a T. Oh my! It's a TTM scale adapter. I only have it set at 1 right now, 0.01.
Okay.
I've only had it on for 3 days. It's just something new Toss came out with.
Okay.
Whoops! I just removed it. Haha.
All right. Hit cancel.
That's not cool.
Hit cancel.
Huh?
I said hit cancel.
There it is, right there.
All right.
So that's what it is.
TTM
I had it set at
scalper.
0.1 right there. Whoops! Not negative, but positive. So that's it.
Okay.
So and it seems to it's giving me. It's really pointing bottoms and tops a little bit better than the PPS, and with the and actually following the candle, looking at the candlestick and what the candlestick's doing, it's kind of playing out, especially with a couple long wicks, and then it comes on as the wick's actually moving it up, giving you a position to take the trade, whether it's long or short. So right now, that's the way I'm looking at it. It'll come on with a candle, using the candle and a long wick. It's giving you a really good entry to go the other direction.
Interesting.
That's the way I'm like right now on the 5. I don't know if that's going to stay. Let me see. Anyway.
Well, if you hit cancel, then it won't change what you had before.
Well, see, like right here on the 5 minute, I don't know if you can see like this wick right here. That didn't flash on until it was about halfway up that wick, and that's just in a 5 minute move, giving you either take it. I mean, if you want to try to just scalp it. Right now, I've been looking at it 2 ways. One, it's giving you directional change, or if I catch it on one of these wicks, I'm half tempted to, because I'm not lying. And this right here came all the way down to here with a full candle, and then the thing went up about halfway, 3/4 up. Then this flashed on. So I haven't committed to it yet. I haven't traded off of it or using it yet. But thinking about taking it for 10 or 12 ticks, and then either let the trade play out if the next candle actually opens up or below it like these. It's really. That's what I'm looking at right now, and that's what I'm seeing using it, is watching these wicks, and then as it's going down the candle, it actually comes on.
Right. And I can see what you're saying. It's picking out the tops and bottoms, basically, of those pivot areas.
Yeah, it really is. And if you really watched it, which, I don't know, and that's what I'm getting at about the day trading, is it really... I mean, you really got to be sitting here and watch this ride up and then watch that flash on, or otherwise, if you turn your head or something, it comes on and you miss the whole. You're going to miss the whole trade, versus if you're just trying to scalp it or use it versus the get in here and then up.
Yeah.
So.
And it looks like
it's working out pretty good so far.
And unlike the PPS, it looks like you don't get the one and then the next and then the one. You don't get the pink and then the purple and then the pink and the purple.
Mm-hmm.
You get instead a couple of purples in a row.
Correct.
Okay.
And not only that, but it's like right here. This is my volume profile from yesterday because it's 95.75. But these are almost coming on where it doesn't blow through this trend line. And I mean, you got 1, 2, and then you got the third time this afternoon. I mean, if you even just waited for the pattern to play out, plus you throw in some of my other indicators, it's tying it all together. It's pulling back and looking at the big picture again.
And there it is, right back in your channel again.
Correct. Yeah, and that's the channel. And this channel I drew this morning. The other one I drew last night or yesterday. But yeah, I drew this when I got up this morning at 5 o'clock off of the opening last night. I didn't draw this till this morning. Tied it there, and then I just popped it out to there. And of course, that one I drew last night off of Sunday night. And I mean, I traded that like right there, and the thing just fell off. And you know what? I'm going to say this too. On days like this downtrend move, before the bell even opens up, when it moves 100 tick long or short, and we opened up with 90,000 shares, and then it kind of pushed itself back up. But my point is, if you get up early enough, there was like 60,000 shares burn up right here, and we're almost 100 away from where it opened up. They just don't give it those. Until the Americans open it up, they just don't give up that side. They don't give up that long or short. That's a great time to trade it at the 7:30 o'clock in the morning. You got so much to the downside or the upside, whether or not it's long or short. The point is, if you watch the volume and you got 60,000 shares here and we've already burned up 100 ticks, there's a really good chance it's going to keep going that way. So that's something I really look for these channels on the after hours with the volume in the play. Anyway.
Okay, my friend. Well, I'm going to let you go so you can do your football schedule. And I understand that you're going to be on with RPM later in the week?
Yeah, I'm trying to do Friday if everything goes all right and I have a great day trading.
Well,
last time it was just uncomfortable, so hopefully it'll be better.
Yeah, well, now you know what to expect from it.
It wasn't RPM. I mean, my screens were flashing, and I was getting anyway. But yeah, I kind of.
No, I heard you. You kind of admitted that you were forcing the trade just to have something to talk about. And
well, my head was so messed up. I wanted to trade. It wasn't that. It wasn't RPM or trying to make a point. I wanted the trades at the wrong time.
Yeah.
But yeah. Anyway.
Well, I'm glad it worked out in the end. At least.
All right. Hey, I appreciate everyone. You know what? I really appreciate that. Going over those options. I think that's going to help out a lot down the road.
Sure. No problem. And you know where to find us if you have any questions.
Yeah. Trade for Pay's backyard.
Exactly. All right. Thanks so much for coming on, Pop29. This is Pop29 you've been listening to here on Briguy's Tools of the Trade on daytradingradio.com. I want to thank him for being on with us, and we'll say a howdy and a good night to you.
Thank you.
Okay. So, that just about does it here for the show, Tools of the Trade. We thank you guys for tuning in. Get up the usual charts here for us. And before I sign off, I had another article that I wanted to bring out on the After Hours show and didn't get to it. And when I was closing out some of my apps here to kind of make room for the program, I realized that I didn't cover it. So let me get to it. And for those of you diehard traders that are still listening here at the end of the day, maybe you'll benefit a little bit from this, and I'll see if I can bring this up again on Thursday. But this is an article that came out early this morning, and I don't think it's tremendous news to us traders because we've been really paying attention here on daytradingradio.com. I see you guys trading during the day and the conversation that takes place, and I think that we're a little bit more savvy than the average trader, if I can dare to say that. And here's what the article is. And Cahill, I see you in the room. All of our shows, it's up, just so you know, I don't recognize your handle, so I assume that maybe you're one of our newer traders, but all of our shows, it's up to the host to record this program. So in this case, I just telling you that because we get a lot of people asking about shows that other folks are doing, and you got to reach out to those hosts in order to get the answer. So in my case, I do record all my shows, and then I have to go through it, edit it. I'll probably just clean up the intro for this show a little bit since I didn't have the Skype working properly, and I might just clip that up a little bit. But otherwise, I'll have to do that, and then I just have to do a conversion of the file and then get it uploaded to YouTube on a unlisted video, and then I will link that video to our members only forum, and you can then watch it from there. So Cahill, if you go to the announcement page either in the email you got today or on our homepage right now, and you look at my announcement, there'll be a link on there to past shows, and you can look at some of the previous shows. You can even watch Pop 29's previous interview, which was a couple episodes ago. But so far, I still have to upload last week's show with Jeff Hirsch, and then I have to do tonight's show as well. But let me get to this article, and then I can turn off the show and the recording and everything, and go make sure the dog's doing okay, because I'm supposed to look in on him a little bit earlier. So here's the article. It's 4 reasons why sell in May won't happen, according to J.P. Morgan. So here's the 4 reasons. I'm just going to summarize the article. Number 1, the commodity sell-off is not a zero-sum game, but rather a positive for global growth. The quote is, "We think it will end up being interpreted as increased purchasing power rather than the specter of deflation." So if you guys can let me know in the room if it makes any sense to you. Number 2, the United States will not repeat the full double dip scare of the prior 3 years. The big difference this time around, compared with the summers of 2010 to 2012, is that house prices are moving up, while jobless claims are moving lower. Some of the big tail risks have also eased, and U.S. consumer deleveraging looks mostly done, with the household debt-to-net wealth ratio below trendline now. Number 3 reason why we won't be selling in May. Technicals aren't being stretched. Hedge fund beta is negative, and investors' expectations for a correction are up, a good contrarian signal in our view. And finally, number 4, the periphery, those troubled Eurozone countries, are pretty stable this time around. Thanks to the ECB, there's no sign of the demon of the past. Peripheral bonds threatening to fall into a vicious spiral of ever-increasing yields. Peripheral spreads should keep tightening. So that's just an observation here from this article. I'll paste the link in the room. You guys can read the other parts of that article. But I think we've kind of, at least I have that conclusion now, just based on the fact that we've hit new all-time highs. I don't feel like the sell in May is going on. It's just a different scenario. There's, we're going to pull back to where? If your upside is infinity, then your 10% or 20% correction is negligible, as it were. Even then, we still have our friend Learjet still posting links to what he calls upside of the SPY. And that's just off of a channel line. But then if you look back, Learjet, you've been running up to that channel line, retracing, running back up to that channel line, retracing, running back up to that channel line. So, anyway, interesting. So that does it for the show. Trade for Pay, do you have an options show set up for tomorrow that you want me to promote? I'll mention it, but in the meantime, come back tomorrow at 8:30 a.m. and you'll have Day Trader Rockstar broadcasting live from Nyack, New York, with our trading show and covering all the news and all the earnings and overnight news that's come out, upgrades and downgrades, and bringing you those great trades from the HPS setups. So check that out. Follow the charts, as D Sharp says, and that kind of fits in with Vester again, which is trade what you see, right? So trade what you see, follow the charts, and let me just bring up real quick the oil and gold here. Just want to see what gold's doing, down $1.40. All right, we'll see where that goes tomorrow. So thanks again, guys, for tuning in to Briguy's Tools of the Trade, and we will see you tomorrow on the next show. Thanks again.